Hey everyone, welcome back to the channel. If you've been paying attention to the global currency scene lately, you already know something surprising just happened with the Vietnamese Dong. Yes, Vietnam's currency, the Dong. So why are we covering it here on a channel that usually focuses on the Iraqi Dinar? Because what just unfolded in Vietnam could reshape the landscape for emerging market currencies everywhere, including conditions that influence the dinar. Stick with us through this video because this isn't just a minor policy tweak. It's a hidden trigger many analysts overlooked, a move that could send ripples through Asia's trade networks, global capital flows, and investor sentiment. That means it matters to you whether you're tracking exchange rates, emerging market trends, or global macro. We'll break down what exactly changed with the Dong, why it's happening now, how it ties into Vietnam's long-term strategy, and how it connects back to regional currencies, including the dinar indirectly. By the end, you'll understand why this moment matters, what could follow, and what you should be watching for. So let's dive in. Over the past week, Vietnam's central bank, the State Bank of Vietnam, or SBV, quietly made a significant update to its official exchange rate mechanism. At first, it appeared to be a small technical adjustment, but the markets quickly realized it was anything but. The Dong strengthened faster than it has in years. Traders were caught off guard, and currency desks in Singapore, Tokyo, and London lit up with activity. What looked routine turned into a clear signal. While Vietnam's official numbers aren't always immediately transparent, what we do know is that the SBV widened the band in which the Dong can trade, allowed more flexibility, and signaled an openness to a stronger currency. Analysts see this as a shift from tight control toward genuine market price discovery. That's big. When a country with Vietnam's export weight lets its currency appreciate, it's a show of confidence in its reserves, its competitiveness, and its economic stability. Why does this matter so much? Because Vietnam isn't a small player anymore. Over the past decade, it's become one of Asia's fastest-growing manufacturing centers. Major global brands from electronics to apparel have expanded production in Vietnam thanks to its strong labor base, political stability, and favorable trade agreements. As exports surged, the country built a large trade surplus, attracted foreign investment, and sustained strong GDP growth year after year. So when the SBV allows the Dong to strengthen, the message is clear. We can handle it. Vietnam no longer needs an artificially weak currency to power exports. Its competitiveness now rests on more than price. It's about quality, infrastructure, and global integration. Markets see that mindset shift as the real signal. For investors, it's the kind of change that can trigger portfolio moves. If Vietnam is entering a new currency era, capital will take notice. To understand why this is so significant, let's revisit how Vietnam's exchange rate system has worked. For years, Vietnam has maintained a managed float. The SBV sets a reference rate and allows banks to trade within a specific band around it. This system, part fixed, part flexible, gives authorities the ability to smooth volatility without fully pegging the currency. Historically, that's meant periodic adjustments, occasional interventions, and careful balancing between inflation, exports, and reserves. Now the SBV appears to have widened that trading band, opening the door for more appreciation, and that it's not a routine change. It's a signal of evolution. The hidden trigger behind this shift lies in four converging forces: stronger fundamentals, global supply chain shifts out of China, ongoing financial modernization with IMF and World Bank cooperation, and strategic timing amid changing interest rate and trade conditions. Yet together, they mark the start of a new currency phase, not just a new rate. And that's exactly what markets are reacting to. Traders noticed the Dong's move almost immediately. Importers and exporters started recalculating, and in major Asian hubs, officials reportedly held meetings to assess ripple effects. When a manufacturing powerhouse like Vietnam changes its currency regime, it doesn't just move numbers, it alters trade dynamics. Within days, neighboring currencies began showing subtle shifts. Export-heavy economies felt pressure. Investors rebalanced exposure. It's the classic domino effect of global FX markets. One emerging currency moves, others must adjust to remain competitive. So this story isn't only about Vietnam. It's about Asia's interconnected export engine and what could follow. Let's zoom in on the US dollar-Dong relationship. For years, the Dong was perceived as a low-value, tightly controlled currency used mostly domestically. That perception is now changing fast. Reports suggest the dong has strengthened two key psychological levels against the dollar. Analysts note that widening the band gives the market more power to find the dong's true value. Back in 2022 to 2023, Vietnam increased its fluctuation range from 3% to 5%, and this latest move builds on that. Some might wonder, doesn't a stronger currency hurt exports? Usually yes, but Vietnam appears confident its advantages run deeper than cheap pricing. Higher productivity, better trade deals, and a shift toward value, added manufacturing all help offset currency strength. By allowing moderate appreciation, Vietnam avoids inflation risk and signals resilience. This marks the transition from a cheap currency growth model to a strong economy growth model. That transition is key. Short-term export margins may tighten, but the long-term benefits are credibility, stability, and sustainable growth. For anyone following emerging market currencies, especially the Iraqi dinar, the message is clear. When a major developing economy shifts its monetary stance, others feel the impact. If Vietnam embraces a stronger, more flexible currency, peers may need to rethink their own strategies. That can mean volatility, reserve adjustments, or capital reallocations across markets. Vietnam's move could attract foreign funds and investor attention, potentially diverting flows from weaker or less transparent markets. The connection to Iraq isn't direct, but it's systemic. The global environment shaping emerging currencies is evolving, and this is one of the catalysts driving that shift. So what could happen next? When a country enters a new currency phase, the next steps matter. Here's what to watch. First, any new announcements from the SPV about rate bans or further reforms. Second, changes in foreign reserves. Higher reserves often confirm support for appreciation. Third, export data. If Vietnam maintains growth despite a stronger dong, confidence will build. Fourth, movements in regional currencies, a telltale sign of wider adjustment. And fifth, global fund flows. If Vietnam draws in new capital, it reinforces this trend. Each signal tells us whether this move is temporary or the start of something bigger. The timing also aligns with broader shifts in manufacturing away from China. Vietnam has trade agreements with the US, Japan, and the EU, modernizing its banking system and digital payments in the process. The dong's rise fits neatly into that modernization path. Of course, no move comes without risks. Allowing currency appreciation can pressure exporters accustomed to cheaper pricing, potentially slowing growth in lower-margin sectors. External risks also linger from US dollar strength to global geopolitical uncertainty. Managing a gradual appreciation while maintaining export momentum will require careful balancing. Capital flows can be fickle too. If sentiment turns, investors could exit quickly. And inflation remains a wild card. While a stronger dong curbs import costs, domestic price pressures could still rise. Analysts caution that while the SPV's shift is bold, success will depend on how policy, trade, and capital dynamics evolve over the next year. For investors, though, this opens up opportunity. Strengthening currency usually boosts confidence, lowers risk premiums, and attracts more foreign direct investment. If Vietnam's currency gains recognition in global settlement systems and trade contracts, it could become a new regional anchor. It could draw portfolio money from weaker emerging markets. For traders, volatility means opportunity. For long-term investors, it means reevaluating exposure across Asia. And for those following the Iraqi dinar, the lesson is this. Real currency transformations come from policy regime change, not rumors or one-off rate moves. Vietnam seems ready to compete not just on price, but on value. With greater productivity, higher-end manufacturing, and deeper global integration, it's signaling a maturing economy. Competitors across Southeast and South Asia will be watching closely. If Vietnam can sustain exports with a stronger currency, it sets a new benchmark that could reshape investment and supply chain decisions. Companies may start viewing Vietnam not as the cheapest option, but as the most stable and efficient. That shift changes regional economics in profound ways. And regionally, the ripple effect could be broad. When Vietnam signals strength, peers must respond. Export-heavy economies could feel pressure to adjust policies or improve competitiveness. This could lead to a gradual Asian currency reset, as some analysts put it, where regional FX values align more closely with modern trade realities.